All right, so earnings growth rate, right? The growth rate of earnings depends on how much you reinvest and how much return that you generate from that reinvestment. Okay? Again, growth comes from your reinvestment. Okay? You can think of it as like a dividend as a party and then the reinvestment as your studying time kind of things. You can, party also, sometimes helps you to refresh your mind, but usually not, right? Your performance really comes from how much hours you spend on studying, right? That kind of things. So reinvestment is that kind of idea, okay? But not only that, you reinvest how much, it matters, but how much of a return, how efficiently do you study matters as well, right? How efficiently do you work out your reinvestment, okay? Matters. In your study, oh, I study like a 24 hours, 7 days a week, right? What for if you are just watching YouTube and just spending your hours like wasting, right? So, no, you have to be efficient in your time management and all your investment cash management, right? So the efficiency has to be there. The both things, okay, multiplicatively affect your growth rate, earnings growth rate into future. So that's conceptually what I talk about over here. Percentage of reinvestment and then percentage of return. You multiply those things and you can generate your growth in your earnings. So earnings, you have either net income or operating income after tax, right? This thing, you're going to talk about it in next week, but this week we're going to talk about these two. So in dividend discount model, your growth in net income should come from your retention ratio times ROE, return on equity, okay, because it is the equity investors' cash flow, okay? And then in free cash flow to equity model, it has to be net income growth rate is coming from equity reinvestment rate. We're going to learn about this concept later, so please bear with me. Times ROE, the same thing, ROE over here and over there, okay? Because this is about, again, the cash flow to equity holders. When we go to FCFF next week, we're going to say that your growth in operating income, after tax operating income, right? The growth rate should come from reinvestment rate times ROC. Okay, ROC, what? Sounds similar to ROE, but this is C, which means capital instead of equity. Well, the capital, we mean invested capital, and those invested capital will incorporate both equity and debt. That's why we use C over here. Okay. Now, expected growth rate in net income for a company cannot exceed its return on equity in the long run. That's what we are talking about over here. Expected growth rate. Usually, in dividend discount model, this is clear. This is your return on equity, ROE. Okay, times your retention rate. This is something in between 0 and 1, bounded by 0 and 1. So when it is 0, your growth rate will be 0, right? When it is 1, your growth rate will be ROE, because this guy 1 and then times ROE should be ROE, but no more than ROE. So that's when we use the dividend discount model. Equity reinvestment rate, it will be more flexible. Your equity reinvestment rate, you are going to learn about it later, but that it is not bounded by 1. Something very positive number is also okay over there. Okay, so that's that. Now, 10 minutes from now, I'm going to bark one more time. Now, that's that. But even in that case, right, you cannot reinvest more than 100% of your net income in infinitely many times. No. Okay? Even in equity reinvestment sense, you're going to be limited in the degree of reinvestment, so much so that your expected growth rate will be in the long run capped by your ROE. Okay, so that's one thing to notice. And then mathematically, okay, how do you derive this relation? Okay, growth rate of net income equal to retention rate times ROE. Okay, how do you derive this guy? Well, it's shown over here. Okay, mathematical derivation. Do it in your free time. Okay, you're gonna see it. Okay, with some numerical example over here. Okay, so it's starting from the first period. Okay, when percentage return is stable. ROE, let's say this is 12%. Okay, equity in existing project is $1,000, let's say, and then multiply it by 12% ROE. That means your current earnings, net income, will be $120. So 100 of current earnings, $100 of current earnings is reinvested from here. Okay, and then the retention ratio accordingly, it will be 83.3%. This guy out of that, okay, will be 83.3%. Now the next time point, how much of a net income growth will be there? Okay, let's see. Equity in existing project, $1,000 is there, and then out of it you still generate 12% return, and then there is new investment. You reinvested $100, okay, in the beginning of the year, like this, okay, over there, and then out of it you also generate 12% return, which is $12, right? Regardless of whether it is new investment or existing investment, you are generating 12% return out of it. So in the end, you're going to get $132 as net income. Okay, so how much of a growth was there from here to there? 10%, right? The difference is $12. Okay, that's 10% of your beginning last year's net income. Okay, last year's net income. So the change in earnings, okay, explains that. Next period's earning minus current earnings. So that's number two minus number one. Okay, number two minus number one. For existing asset, existing investment projects, the difference is 0. But the difference comes from your new investment. Okay, the real difference in your earnings, real growth in your earnings, come from your new investment. Okay, if you don't reinvest, there will be no growth in your earnings, right? Earnings. So in your earnings, how much of growth do you make out of $100? 12% return, $12 over here. That's identical to this number. So that's the idea over here. Okay, so the growth rate itself, okay, should be your ROE, which is 12% times your retention ratio, 83.33%, and that is 10%, exactly the 10% growth that you observed before over here. Okay, so your net income growth rate should be the multiplication of those two numbers. All right. So dividend discount model, okay, KTNG, we are not finished yet. We are just in the middle. The value of this company should be future cash flow, which will be dividend 1, and then R minus G should be there. Cash flow 1, yeah, expected dividend payout ratio will matter. R should come from CAPM. So let's see. Growth rate. This is perhaps the most difficult part, right, in your valuation exercises. So here we are interested in net income growth rate, right? The mathematical relation looks like this. Remember, this is the only one of the many ways of projecting growth rate. This is using economic fundamental relations. Fundamental means the variables that is rooted in economic explanation. For example, retention rate and return on equity, all these kind of things are fundamentals. Now, reinvestment related ratio in dividend discount model, it should be retention ratio, which is 1 minus payout ratio by definition. Payout ratio is about the dividend payment divided by net income. Anyway, expected ROE is important, and ROE is defined as, okay, expected ROE is what we care about, and this is defined as net income divided by book value of equity at the end of last fiscal year. Okay, so in the time horizon, this is t minus 0, t fiscal year t minus 0, t minus 1 finishes over here. Okay, book value of equity, well, that's balance sheet item. It's like a snapshot. Okay, snapshot at the end of the period. Net income, okay, net income is kind of a video, okay, motion picture kind of videos, right? It's not a snapshot. Okay, how much did you earn over the last year? Okay, that's net income. Okay, the idea is, well, based on last fiscal year ends snapshot book value of equity. Okay, you have a stock amount of investment, equity investment. Out of this, how much of a profit did you generate? Okay, net income. That's this guy. So that's why we have t minus 1 and t over there. Okay, t minus 1 and t. So return on equity measures how much net income does $1 of equity investment generate, okay, at the beginning of the period. The more return you want for a given amount of investment. Hence, it is a measure of management efficiency. In reality, it depends on the ability of top management team. Okay, if the top management is a very, strong guys, right? High ability CEOs, then ROE will be big usually. Okay, low ability CEOs, lower ROE. Of course, there are some artificial ways to increase the ROE by taking more leverage, doing business with more borrowed money, but that's not the focus of over here. Okay, what we care about is the efficiency and the ability of the managers, because we're going to use this idea later on in FCFE as well. In this example, we will just take ROE as given, and then what matters is expected number. Normal business situation, yes, expected payout ratio about 7%, expected EPS growth rate, ROE times retention ratio, carrying it from the history. We are just assuming that history will repeat itself. Okay, if you don't like it, you can impose your own assumptions, but this is what I assumed. Okay, so if you multiply these two, the expected growth rate in net income turns out to be about 3% over here. Cost of equity using CAPM should be like this. Korea's treasury rate minus default spread plus beta times equity risk premium 5.5%. So in normal situation, well, the first dividend payout will be like this. Okay, your existing per share based net income, earnings per share, times 1 plus EPS growth, which is this 2.99%, and then times the payout ratio, okay, 97% or something. All right, so divide this guy by R minus G, which is 5.5% minus 2.99%. That gives me 131,451 Korean won. That's value estimate of KTNG, right? 담배인삼공사. That was close to their market price, okay, at the time of demonstration, like a couple of years ago, all right? Anyway, in case of war, right? Okay, 1 minute left, right? In case of war, expected payout ratio should be smaller, right? Because this is very dangerous situation. No time to party, right? Expected EPS growth rate accordingly will change, right? And the thing is, expected ROE will be also changed, okay? We assumed it to be 3%, okay, in a statement. Now, if you multiply, then you will realize that the growth rate of net income will be only 1.85%, okay? Cost of equity, how is that? Well, don't touch it, okay? Let's assume it to be the same, because if you adjust the cost of equity in the wartime, you will be double counting the effect of war. You are adjusting the cash flow channel first. Cash flow channel here, right? So one channel is good enough. Discount rate channel, don't touch it. So that your valuation number in case of war would be 44,587, as you see it below. Now, your valuation number, okay, by the way, valuation number should be the probability weighted average of these two numbers. Okay, these two numbers, 127,108 Korean won. Okay, did I say this guy was close to the stock price before? No, not really. This guy, okay, was the one. Okay, sorry for that confusion. Anyway, so this is how we get to the value estimate of a company using one-stage growth model. One stage stable growth, okay, using dividend discount model, okay. So that's it.